So do you want to talk to them about what that actually means for the viewers at home?
Well, sequencing risk is essentially the risk of the timing of your drawdowns.
Yeah.
So, for example, and just very simply, if you had to sell your share portfolio and the shares were trading at $1 a share, and you had to sell 100 shares, that's a pretty easy equation to work out. But if your share portfolio dropped by half, all of a sudden you're selling twice the number of shares to get the same outcome.
Yeah.
So you're destroying portfolios that will never ever recover. They just won't recover.
So and it's also that timing, isn't it? We talk about that volatility. If you are on the cusp of retiring, you have a GFC type experience of a tech bubble, whatever it might be, your capacity to recoup, you lose 50%. Well, it can't just be 50% improvement now. It's got to be 100% improvement to get back where you were. And it comes down with the escalator and it goes up.
And in the meantime, you're drawing down as well.
Yeah.
It's never going to recover.
So how do you get your clients to manage that? How do you get them to talk about that? What do they do? For us, you buy more fixed income. It's just as you get older, you buy more fixed income, so you have less concerns about that loss of capital because you're less likely to have it.
For our decumulating clients, our only focus is liquidity and cash flow. Cash flow is king.
Correct.
If you get that piece wrong, it doesn't matter how good your performance is, it doesn't matter.
Exactly.
It just doesn't matter because you're never going to recover what you had lost anyway. So our focus is making sure that we have set aside sufficient cash in a cash bucket to draw down their pension payments, a level of fixed income to top up the cash bucket when required, and some share portfolio, some income. So you look at that portfolio, very few people these days have enough capital given the income that they need, very few. So we're drawing down from various areas over various times. So my objective is to, when equities have rallied, take some of the profits, top the cash up and keep the process going forward. So managing sequencing risk is putting your clients in a situation where they don't have to draw down assets that have gone down in value. That's it.
Yeah.
And if you can manage that process, you'll never put them in a bad position.